Thank you all for being patient as we're dealing with technology. Hey, let's move on though. Banking in the crossfire, earnings regulation, and the trade war shakeup. We have an outstanding panel to talk about this. John, I know when we've had our pre-calls, the content on this changes daily. You have put together an excellent panel of 4 experts to lead us through this. And John, I'm going to stop talking. Well, actually, we want your questions. Do your questions, and we'll save them for the end. But John, let's get right into the presentation and tell us what we need to know of how all the chaos that is happening, how that's affecting our institutions, man.
Yeah, so an often repeated comment has been investors don't like uncertainty. So with that note, Chris Marinac, who covers many of the regional banks and some smaller public banks as well, is to give us a recap of the current quarter, as most banks have now reported their earnings. Chris, take it away.
All right, John, thank you very much for having me, and welcome to everybody. I look forward to our discussion today. So we are about halfway through the bank earnings season through today, 22nd of April. Most of the big banks and regional banks have already reported, so it gives us a pretty good background. Just a few things I want to talk about through the chaos that we see in the marketplace today. There obviously is a fear of credit issues and new credit losses. I think investors definitely care about not only what the bank's outlook is in this next quarter or two, but also kind of the ability to weather the storm, whether it be from a capital standpoint, earnings standpoint, as well as existing reserves. All those three matter. We've been fighting for quite some time with misinformation. It's a fact of life. There's a lot of, I think, reporting that's incorrect, whether it's on banks specifically or just in the market in general. We have to continue to not only do our own homework, but also kind of put things in the proper context. And what I see a lot are headlines that are reading negative because it's looking at a data point year over year, but it's not looking at the right context, which is to look back beyond a year, back to COVID, perhaps back to prior periods to really put things in the right framework. The banking system is in a much better position than people realize. I think that is true with the earnings and a lot of the results, and the absolute level of credit issues are still very low compared to history. I'll show you a few graphs for that. And I think in most investors and bankers' standpoint, there are certain things that they cannot control, which goes back to tariffs and trade wars. We all have to react to it. What our focus, and I think most banks are doing, is thinking ahead and trying to get ahead of the issues where they can. And I think you've seen that addressed in terms of some reserve building this quarter, but also in terms of what is happening on net charge-offs. And in many cases, what is not happening is net charge-offs really haven't changed too much. So if we move to the next slide, again, just kind of hitting on some of the fears that are investors' minds. I think the other point that is out there is that the Fed may or may not ease fast enough. That could lead to net interest margin stalling after some recent improvements. We're also worried about loan growth disappointing. I would tell you that loan growth expectations were already very limited, about 3% for the largest banks and about 5% for the mid caps. By certain, you're going to see 3% go back to 1 or 2, and then the 5 is probably going to be more like 3 or 4. I do think that there is certain flexibility in bank earnings, even with a pullback of loan growth, because most banks are actually still seeing deposit cost improve. They're also seeing some refunding of securities that are being paid off and redeployed at higher yields. And believe it or not, securities interest income actually has been a growth source for many companies. They may not talk about it, but it is definitely happening if you look at the composition of bank income statements. And then, of course, we do think that Bank M&A is still out there as a theme, but it is definitely slower by virtue of this noise in the month of April, and to some extent, what has been leading up to the April trade war and trade fears. So if we move on, the opportunity is still that banks are seeing renewed new loans coming on the books at higher yields. We're still paying off the vintages of 2020 and 21. We're also seeing the ability for credit cost surprises to be covered by PPNR or pre-tax, pre-provision revenue. We still think PPNR is very strong in the banking industry. We've seen limited non-performing loans limited accrue or not accrual interest issues. That was a bugaboo from the 2008 and 9 area, and that is not an issue so far. Could become one over time, but I think it's very much not an issue at the moment. Still strong cash flow going through. And I would also argue that some of the changes out there on the regulatory reform haven't yet hit. It's starting to form. And just like 2007, or excuse me, 2017 with the new administration, it takes about a year for some of these regulatory changes to really take hold. So as we sit here in late April, I think it's still early innings for the regulatory reform that is out there. So I'm going to move from the opportunity slide over to loans and deposits, 2 slides ahead, Anna. And when we talk about the loan to deposit ratio, it's still very low in the industry. It's 70% today. It was once 96, and it's come all the way down. It came down after the great financial crisis. It came down again after the COVID era, and it really has only recovered modestly these last 2 years. Deposits are still doing well as an industry. The bank loans have simply not come back. A lot of that has to do with tepid loan demand, particularly from the regulatory front. Yes, we have competition from the private credit world, but I think private credit still lends at different leverage and different yields, and different rates rather, than what the traditional banks do. So I'm not really using private credit as an excuse for lack of loan growth. I think it has a lot more to do with the fact that demand simply just has not been there. And it's also become harder for the banks to lend from the regulatory backdrop. They have less incentives to lend. And I think removing some of those obstacles under the current administration could be very useful. It's just not happening fast enough, but I think it is still out there to play out. Next point we make about net interest margins, we have seen a recovery here the last 2 quarters. I still think there's more margin improvement to go. I think the cost of funds is still rolling down. We've had pretty big moves with the Fed cutting 100 basis points last fall. The full impact of that is now realized in Q1. But I think there's still some CDs that are repricing, some exception rates from deposits that have gone away. So I think you're going to see very modest drops in cost of funds in Q2, but it's probably going to still be net lower a few basis points from here. By the same token, loan yields and the improvement on past loans being renewed is going to keep earning asset yields such that margins, I think, will be a basis point or 2 stronger. And if not, they'll be more flat and stable with the first quarter. I think margins were better than expected in general for the first quarter, not by a ton, but by a few basis points. And again, I think the direction has been positive. We're not looking for margins to recover a bunch. We're just looking for them to be better than they were and to contribute to the cash flow of a bank. The loan charge-offs, 2 slides ahead, Anna, focuses on where we are for loan losses. Still seeing the biggest banks in the country writing off 40 to 50 basis points. Now, a lot of that has to do with the largest banks taking on more credit card and a little bit more consumer exposure than they once did. I think the mid-cap banks are going to be more reflective of what's really happening, which is that losses are low. They're still grinding. If they're going up, they're going up 1-2 basis points, still de minimis, and we're still lower than we used to be compared to history. So this graph goes back to 2018, but if we went back further and going back to 15 or 14 or even 2011, you would see the banks were writing off, more like 25, 30 basis points in the past, and now they're writing off 15 to 20. So we're still at a low loss rate. I think banks have plenty of tolerance for those loss rates to go up, although the expectation is that charge-offs are still going to be relatively limited here this next couple quarters. Does it change with trade wars and in issues that are developing before our eyes? Maybe, but if they do, the banks have reserves and earnings to cover it. It's not a huge concern. It's more about trying to calibrate how much money the banks will make, not whether they will make a profit. And that gets back to some points about book value that I want to hone in on. Book value this quarter is largely going up 3 to 4%, some cases higher on a late quarter basis. It is influenced by the mark-to-market positive on unrealized security losses. We think that there is still more positive marks to come as securities are paid down and also interest rates have evolved. Right now, the mark is flat for June, but we did see a positive mark in the first quarter, and that's also going to translate into loan marks coming down as well. We think book value will continue to grow even without the impact of these valuation marks. We think banks are retaining earnings, they're buying back stock, and you still see net improvements to book value somewhere in the neighborhood of 5 to 8% organically. And then if you add on the benefit of the marks, you get to kind of 11, 12, 13% growth, depending on the size of the bank. Your biggest banks are going to have the biggest AOCI positive marks just because they've got bigger securities portfolios. But even the small banks who don't have a lot of securities, they are still seeing improvement in book value per share. So that's a positive that we see in the quarter. 2 slides further is our point about PP&R. We like to talk about pre-tax, pre-provision as a percentage of loans. Most banks are earning somewhere between 2 to 3% in terms of their percentage of PP&R. That's very powerful if you think of a credit cycle lasting 2 years or longer. So when you kind of take 2% of loans and you double it or even triple it over the next few years for a cycle, there's a lot of cash flow to loans that banks could fund provision expense above and beyond what they already have. And so that's a fundamental benefit that the banks have today is the earning stream is much better than prior years. And we're just in a much better position to weather sort of the unforeseen losses that are still on investors' minds. And if I move to the next couple slides to finish, we have seen stock prices for banks drop about 21% from the peak level in February, which basically discounted all the election excitement and deregulation and thoughts that M&A was going to surge immediately. That has led to now focus on earnings and possibly seeing banks make less money than they did before. We think the haircut to earnings is somewhere between 8 to 10%, not the 21 that's been implied by stock prices. And this 8 to 10% has more to do with provisions going higher for net charge-offs, a little bit of less balance sheet growth. But honestly, we have not cut estimates on a lot of cases. We simply think that those estimates could change in the next 2 months as we get clarity on where the trade war, tariffs, and economic outlook goes. If we are going to see a recession, that's going to drive some of those estimate changes. But ironically, the bank guidance has been more stable to simply cautiously optimistic. And while there's a lot of uncertainty, and I'm kind of tired of hearing the word uncertainty from all these earnings calls, I do think that the outlook for profitability is more stable than it is to cut. And we've been through many environments before where you really feel compelled to cut estimates. We don't feel that as much. I think there's a time to be conservative and thoughtful about building reserves. I think that's where the conversation is going to go for bank earnings, but it's not going to lead to some wholesale cuts of profitability. It's going to be more moderate declines and nothing substantial. So that's kind of the look that we have it today. If you look at the relative valuation, the banks are trading about 40% multiple of the Russell 2000. That's about 5 points cheaper than the median. And we've certainly seen times before where the banks were trading at 60 to 70% of the Russell 2000. And we think that that can come back. It may be perverse that we see the banks go down less if we have a recession and the Russell and the S&P go down more. That may be one way that banks' relative valuation improves. But we generally feel that there's a very good, healthy backdrop to where valuations are limited. And I think your downside risk after all this noise in April should be somewhat ring fenced because of the profitability and capital of what the banks have in place. So John, with that, I may have overstayed my time allotment, but I'm going to turn it back to you.
That's great. No, that's great color. Chris is obviously bullish on bank stocks. Jason, Ed, do you agree, disagree?
Yeah, I'd say a few things. I guess, I think the timing and the calendar are quite interesting. And, really the prints we're looking at are kind of based on, obviously, what's been reported and kind of going in assumptions to some extent about administration and policies. And, the so-called Liberation Day and the current, trade war and tariff environment is obviously after that, and that's giving that, chaos and possibility of, I guess uncertainty that, Chris loves so much, but, the possibility of a recession. And I think we're starting to see, people talk about that. And obviously the big question is, where do we end up on tariffs? And then there's a lot of different impacts that come back potentially, to the banks. But I think that's the big thing that's hanging out there that's, causing angst here.
Yeah, I mean, the threat of a recession has been looming for quite a while, right? Because there's a natural cycle, and I think we're probably a little overdue for one. Although that's, I'm not the expert on that. That's more of Chris. I think that the salient point here is when you just take a step back and look at stocks, specifically bank stocks, but all stocks, and you look at where they were trading pre-election to where they are now, there's on a general index level not a significant decline. So you have to then look and say, well, what was the increase between pre-election, a couple days before election, and the end of the year, or the announcement before right before the announcement of tariffs? What led to that rise? You can't really point to earnings or jobs data or inflation data because it was all trending in the same direction, but we saw the significant rise. I'm not going to speculate. I think a lot of people can speculate on what caused that rise. There's enthusiasm over the election in many cases for investors. And so, where are we today? I think it's kind of a reset. And does that mean, well, we're definitely going to have a recession because we're resetting? I don't know. It could cut both ways. I think there are looming credit issues, as Chris mentioned, and those looming credit issues could become bigger credit issues. But at the same time, if all of this leads to pressure, I know we're going to talk about this later, but if all this leads to pressure on the Fed to reduce rates, well, we also have a lot of looming credit refinancing this year. And if that means that credit is going to be able to refi, then yeah, there might be some compression on NIM, but at least you're not going to see significant losses. So, I think on balance, I have no idea where it's going, but I think on balance, I'm not, ringing the bell that, oh my God, it's doom and gloom.
Yeah. I mean, the euphoria for the new administration seemed to peak at that AOBA conference we were all at. And then there's been some comeback from that. I've had a lot of conversations the last few weeks with chief credit officers, and most bankers tell me they're worried about small business loans. They're looking at their portfolio to see their exposure to government contractors, as well as GSA leases on the CRE side. They're worried about the travel and leisure sector and companies impacted by tariffs. What are you all hearing from bank executives on what they're worried about? Is that consistent, or are you hearing some other things?
Well, I think it's kind of a tale of two cities, right? The concerns for community banks, I think, are very different than the concerns for larger regionals and money center banks. I think the tariff threat certainly would seem to affect the customers of larger banks sooner. And the tariff effects and potential recessionary fallout of that, I think, would hit community banks later. I mean, community banks tend to have a lot more residential lending on their books, and consumers are going to let those go into default last. And so larger banks that are sitting on a lot of credit card debt are going to start seeing the concerns about that. So I really think it depends which bankers you're talking to on what their thoughts are going to be.
But I think I agree with that, Jason. But I think John, your point. I think that bankers are going through their relationships, their lending, and there's obviously a lot going on. But there's the DOGE related activities, there's the tariff related activities, there's cutting government spending itself, and leases, and then there's government contractors, and then there's those impacted potentially private companies by tariffs directly, and then there's indirect effects. So you can chart a number of different types of impacts, and I think folks are going through their loan books and their relationships and looking at in those different categories how are they potentially exposed. And certainly Jason, to your point, every bank's going to have a different footprint and different level exposure, but I think everybody is and should be going through that analysis.
Yeah.
Well, and there's a big unknown, John, right? Is ultimately, do tariffs go down? If the administration is successful. I doubt that the case for China, but for other countries. And so does that have a net positive effect on your borrowers? So I think, Ed, to your point, it's really, it's a detailed analysis and maybe, certainly prudent to do it now, but premature to make decisions about it.
Yeah. That's a great timing for our first poll question. Will there be a recession in 2025? The poll question should be pulled up in your chat function. Will there be a recession in 2025? Yes, we are already in one. Yes, no, not sure. All right, let's. Wow. It seems like early sentiment is pretty high. Only 16% at this point are confident there won't be one. So it definitely seems like the sentiment of bankers is slightly bearish. Chris, are you hearing that from? Let's close the poll question. Are you hearing that on your calls, or are bank CEOs and credit people saying outright we're expecting a recession, or they being more guarded?
No, they're saying the opposite, John. They're saying that the economy is going to still be in a positive territory, maybe 1% or less, but they're not calling for a recession. Having said that, they're very prepared, and they've kind of counted on a recession in their loan loss reserves. And remember, CECL was the accounting standard adopted in 2020 for the large and mid-sized banks and everybody else in 2023. That's now behind us, and reserves have been built to kind of tackle some scenario of a recession. The question, I think, is fast forwarding those losses sooner versus a 3-4 year time frame that CECL establishes. That's going to front end load losses, which therefore means some reserve building. That's the earnings estimate changes that I think we're all handling, and I think it's been very modest in terms of what's necessary today. We're waiting for more signals as this second quarter plays out and even into summer. But that's kind of the deal. I don't think there's an immediate recession that people think. They're worried about it, but I think the outlook is that we're still going to muddle along in slightly positive GDP territory.
Yeah, I'm interested regarding the consumer. In the last week, the administration has done two things that could create some problems. One, the FHA is no longer going to make mortgage payments for delinquent borrowers. There was something like 55,000 loans last year that went delinquent, and only 9 are in foreclosure. So you're going to see a approach of servicers enforcing their rights. So you should see some more foreclosures. So that'll have an impact. The other big one was actually yesterday. For the first time since 2020, the Treasury Department is actually going to start collecting on student loans. Sorry, the Education Department is going to use Treasury, and they're going to start taking 15%, up to 15% out of someone's paycheck, and they can do that without a court order. So thoughts, Jason, Ed, on how the consumer might respond to some of these changes?
Yeah, I'd note one other thing, John. I actually just saw come across today that Treasury Secretary Bessent was talking about the trade war and said that, relative to China, that he expects that will be resolved and that, discussions will occur. And I think that, that's kind of the biggest area outstanding in terms of the trade war. And I think a lot of this recession talk is kind of based on a view of a maximal, if you will, trade war, and then the impacts coming back, from that. And if, we're in an environment where, the party with the biggest difference, is going to be resolved, then we're not going there. At least that's what that would suggest. So, I think there is some good news, at least intentions out there. Certainly, the items you pointed out are, going to strain the consumer, which would, contribute, to some challenges there.
Yeah, John, taking off Ed's last point there, I think there are some consumers that are smart enough to know that student loans, it would be extinguished if you were to pass away. And so just that general idea, they think, hey, I'm sorry, I meant education loans. Their education loans, though, that's the last one I'm going to pay. And I'm going to make sure I pay on my credit card debt. I'm going to make sure I pay on my car. I'm going to make sure I pay on my house. And so if they're starting to take, a percentage out of your paycheck to start servicing those education loans, that obviously reduces the dollar in the pocket for the consumer. And then you add into the fact that I think I read that it's a 5-to-1 ratio of the products we buy from China versus what we sell to China, and Target being concerned about their prices because they have so much in their shop that is sold by Target. You add those two pieces together, and I think from a consumer perspective, direct consumer perspective, it's very concerning about being able to meet your bills because suddenly the goods you buy are more expensive. You have 15% less income. What goes next? Do you stop paying on your car, for example?
Yeah.
And where do we see issues start percolating in the consumer lending world?
Yeah, it's 5 million borrowers who are delinquent in their student loan payments. So not a small number. Chris, one thing that I noticed in the earnings that sounds intuitive, maybe you could give me an explanation. It seems like chaos is good for trading, but bad for investment banking. Can you expand on that? Because it seemed like bank after bank that did both showed revenue down in investment banking and more profits in trading. Could you expand on that?
Sure. Well, I mean, the volatility in the markets, particularly in fixed income, leads to more activity. I think the idea is that you'd have a very big month of April, given what transpired, since the second of the month. Investment banking and doing deals, whether it's advisory or capital raises, has to do with confidence. And when the market slips and there's a lack of confidence, and clearly that occurred here in early April, it takes away and delays deal making. So I think there's still a lot that's on the table for potential M&A and potential capital raises. It's just the market is not conducive for those when you have stock prices sharply decline over a couple day period. That sort of lingering bad breath, if you will, is still with us in the marketplace. But I think the volatility certainly was pretty good in the first quarter. That led to record trading, or at least strong trading in many of the biggest wirehouses that are part of the banking system. The challenge is if you're a mid-sized bank, that doesn't really affect your business. You might be doing some merchant banking and advisory work, and that all has been curtailed for the moment. It's expected to come back, but it still is curtailed. And so that still is a headwind as we think about this next quarter in 2Q.
Yeah. Excluding, because we'll get into CFPB and CRA in a second, but excluding those two areas, what are some of the wins that banks are getting from the new administration?
Yeah, and John, I look at the regulatory and compliance world, and there's kind of the supervision aspect of banks being supervised, and that's where they really feel it day to day is the contact with the regulators. And then there's more of the sort of regulatory policy and agenda, if you will, which in some ways is a little more forward looking in terms of how will regulation be conducted. And I think there's actually a lot of activity on that front, probably more on that front than the day-to-day supervision. I'll just quickly tick off a couple items. Again, Treasury Secretary Bessent has talked about refocusing examinations on, more defining unsafe and unsound practices, using financial risk measures rather than sort of judgments, and focusing on management and governance, which has been problematic. The FDIC withdrew 4 rules, recent rulemakings recently. There's been a significant reduction, in staff at the CFPB, 1,500 job cuts, 50% reduction in examinations going forward, some job cuts as well at the FDIC. And interestingly, as part of the budget bill reconciliation markup, the House Financial Services Committee Chair French Hill said that reforming the CFPB's funding structure is the principal focus of the Financial Services Committee's work on the budget reconciliation bill. So I think one can expect a really significantly revamp CFPB. I know we'll get into more details on that going forward, but I think clearly a different take on the regulatory policy going forward and alleviating some of the pain points in regulatory policy is what we're seeing.
Yeah, I think that is, a good indication for optimism. I will tell you though, early feedback on ROEs and examinations this year since the new administration have essentially, I think as we discussed or predicted last year during this call, were pretty constant and disappointing for a lot of banks. No change in that regard, still getting hammered on liquidity at a lot of banks, in some cases still getting hammered on assets. And so from the examiner level, I think it's been relatively constant. But as Ed suggested, I mean, there's certainly reason for optimism going forward. It's going to take a while for that to, I think, really work its way through the direct examination of banks, though.
It sounds like M&A approvals have sped up. The Discover deal with Capital One was, I think, approved this week or last week. So that's been the M&A side, Chris. I mean, you've seen some more. Well, it's hard to get deals done. At least banks know that they'll get a speedier answer.
Absolutely correct. And I think that getting Capital One approved is a really good thing. Many of the smaller bank deals have been approved in much faster time. Jason can attest to that better than I, and what's in the pipeline that he knows about, I think has relatively quick, 4 to 5 month tenure, which is certainly faster than we saw in prior years.
Yeah, I mean, I'll get more aggressive than the 4 to 5 month. I mean, there's deals that are clicking in on 75 days for approval. And so you're well capitalized, well managed. I mean, the regulators, I think, see the need that they created. They created it for consolidation because of all of these additional costs that were placed on banks in the regulatory scheme. And so I think they are viewing these transactions positively. Not that they weren't in the past, but there's definitely been a focus on getting them approved more quickly.
And I think, even tangibly, the FDIC withdrew its recent merger rules, which would have added, a little more complexity to the process. And I think the OCC would have been more involved as well. So, we're seeing that, play out a little easier environment.
The FDIC blew those rules up, right?
That's right.
Yeah.
You're reverting back to their previous merger rules.
Well, let's talk about the CFPB. It's been a bit of a wild ride. CFPB was going to be gone, then they brought the people back. There was a memo last week from one of their top officials, which seems to suggest that they're going to pass the baton on consumer enforcement and regulation to the states. I believe the CFPB is in charge of 12 consumer statutes. So how's it all going to work, Ed?
Well, it's clearly a different view of operations for the CFPB, and frankly, in some respect, a restatement of the mission. And I think notably in that memo you talked about, there's things like refocus on tangible harm to consumers. And before, there were cases where the CFPB was using like statistical analyses of harm, and they're also focusing on penalties being based on the actual harm that happened to consumers, and not just some numerically driven amount that, frankly, that money then goes back to them, the CFPB, to buff up, if you will, their coffers. So it's going to be a significantly different environment. Another thing, for example, is a focus on mortgages, data violations, consumer contracts, overcharges and fees. So really trying to get at transactions that are sort of day-to-day, if you will, with consumers and possible harm and impacts that they have. So clearly, as you point out, they are going to hand where there is overlap regulation back to the states and not have federal oversight, some considered an overreach by the federal agency, the CFPB in this case. So it's a completely different view of how that agency should operate.
Yeah. Well, let's bring up the next poll question. regarding regulation. While we're doing that, it does seem like the CRA rules, I know that a lot of the bankers on this panel are interested. It does appear that things are going back to where they were before. So the current CRA rules look like they're going to stay in place. All right. Under 3 months on the new administration, has your bank seen significantly less regulation, moderately less, no change, slightly more? Any thoughts on CRA, Jason, while we're waiting on these?
Well, I mean, I think that you are seeing just a general approach by the administration in a post-Chevron world. And I think that, as Ed had mentioned, they're looking less at statistical meta-analyses, and they're going to try to implement rules or pull back the rules that really get to the original mission of the act in terms of the anti-redlining type stuff. But it got a little out of control in terms of how it was being applied to banks, and frankly in an unworkable way. And I think there's the fact that the administration and presumably Congress is recognizing that. I don't expect there to be firm, I could be wrong, firm changes right now, but the pullback from the additional regulation, I think, is the step in the right direction.
Yeah. Well, look at these poll questions. A lot of this is simply timing, right? As I think, Ed, you mentioned, it takes about a year, or one of us mentioned that it takes about a year for the new administration to really change regulation. So obviously, the folks that have weighed in have been mostly, we're seeing moderately less regulation.
Well, and
John
said
more.
Yeah, and John, just remember, when you're quote unquote changing regulation, and this goes further to my point, is you're either pulling back rules that you think you have the authority to pull back or that were issued without authority. But if you're going to change regulation, you're really actually implementing new regulations that are just applied in a different way, and that just takes time.
Yeah, it seems to be the consensus. One of the big things that concerns typically the regional banks that you cover, Chris, is there's been this gradual walk back of the higher capital standards, which I think were rolled out a year and a half ago. Anyone know where that stands? I know Michelle Bowman has been nominated as head of supervision, so that's obviously a topic she's probably going to tackle. But do we have any clues as to what's going on with that proposed rule? And let's end the poll question.
So her speeches have indicated that they're going to walk that down. I wouldn't say it's going to be eliminated, but I think it's going to be changed a lot. I think part of that is also a little bit of relief on the LCR, liquidity coverage ratio rules. That'll be really big for the regional banks who are holding a bunch of cash. The question is going to be, does LCR get lightened up in the midst of a new recession, by late this year? In which case they're going to want to have more liquidity anyway. So, that effect and benefit may be delayed and or slow played. But I think in terms of the Basel III endgame, that is definitely being backed off. And I think it is going to be a little bit easier as a result. So that is definitely a win. And it's a question of just sort of when it is officially in the books. I think getting Michelle confirmed in the next 2, 3, 4 weeks will be useful. We just had the acting SEC commissioner get named official, yesterday. So these confirmations are happening. And as they do, then you'll start seeing some of these big things and big dominoes fall.
Yeah, I mean, it sounds like Michelle Bowman's an ex-community banker. So
correct.
I would imagine that would bring some more sensitivity to regulatory tailoring. Wouldn't it, Jason, Ed?
Yeah, she actually, and I looked at some of her speeches as well as Chris has, and I noticed that, she emphasized 3 things in one of her recent speeches: prioritizing safety and soundness, reviewing the commitment to regulatory tailoring, and that means for different size and scale banks, and then increasing transparency. And I thought those are all, well-placed items. I just add a couple quick comments on the whole reg capital arena and Basel III, and I agree with Chris's comments. Treasury Secretary Bessent said that the U.S. should, in his words, selectively borrow from those standards and then otherwise determine its own regulatory framework. So that's clearly a different posture, than has been articulated before. And certainly this would apply to the mid-size and larger banks, notably. And then one other quick comment was that there's been changes made to the stress test program where now there'll be an averaging of the results for 2 years. And the intention of that is to reduce volatility in the stress test capital requirement. And I think they've also stated that there will be further changes, going forward, but nonetheless, an immediate effect to reduce volatility from the stress capital side. And again, that's oriented towards mid to larger banks as well. But, clearly more to come on this front.
Yeah. Yeah, it's interesting to see this fight between the president and Powell. How do you all see this playing out? There seems to be a lot of pressure from Wall Street to keep the Fed independence, but curious to see how you all feel this will play out.
Well, I'm not sure the Fed has demonstrated a lot of independence over the past, 5, 7, 8 years, but just, taking the premise of your argument about that, let's say, are they going to be less independent? Maybe is a way to say it. Look, Trump, before he even was inaugurated, was already trying to pressure Powell, and there was a big spat between them. I don't see Powell caving. Does Trump take further action by removing him? I don't know. Will that be upheld by the courts? Who knows? I think there's something to be said that what Trump and Bessent are doing is potentially meant to pressure Powell with rates, and hoping he just caves naturally based on what's happening in the economy. I would think that if Trump was going to take action, he would have done it by now, but it's hard to predict with somebody like that. So,
yeah, great time for a poll question. Let's continue the conversation regarding the Powell-Trump fight. If you guys have any other comments, but this poll question is on the federal funds rate. What will it be by September 30th, 2025? It seems like the consensus is a quarter to 50 basis points so far. Chris and Ed, thoughts? Is that kind of what you're thinking?
Yeah, we've used one rate cut this year and another one early next year. That's been my thought, that there would be a move, but not necessarily right away. And then back to the point about pressuring the Fed, I think that's a lot of noise. I really don't think that the chairman's going to cave, nor is the president going to remove him unless there really is a cause to do so. But Badger J. Powell, I'm sure that'll be a weekly, if not daily, occurrence. That's just part of the deal at this point.
Yeah, I think one positive thing in there is that Bessent has been very vocal, at least reportedly, about the independence of the Fed, and specifically relative to monetary policy, and then Jerome Powell's, tenure supporting that. And I think he even used the word jewel box describing the Fed. So hopefully, Trump listens to that, and it is just noise, as you suggest, Chris.
Yeah, I mean, it's self-evident the countries that don't have an independent Fed generally have higher inflation and worse outcomes than countries that have an independent Federal Reserve or equivalent. So it seems likely that will stay just noise. Let's talk about M&A. I mean, there was a lot of euphoria for M&A. Investment bankers are very excited, and it seems like across the board, be it bank M&A or middle market or large market M&A, has slowed down due to uncertainty. What do you all think happens with M&A this year? Is this just a temporary pause and a bunch of deal making happening, or do we just need to lower expectations for M&A this year?
Chris, I thought you were going to opine on that, but go ahead if you're going first.
Sure. I'll just say that I think that the deals are still going to happen. I think there's a lot of talk about seeing big M&A and big regional bank deals. That's more of a 26 and 27 phenomenon, teed up by the regulatory reform that's going to be happening these next 2, 3, 4 quarters. I think the small bank M&A is continuing and will continue to happen. There were a handful of announcements in March and in the first quarter. I think there'll be more. Certainly lower stock prices are pausing that. But we'll still see consolidation. You know, the lack of succession planning really is a catalyst for these companies to go away. And I think that is a general theme that has been playing out for several years. It's not changing. And if anything, the faster turnaround time is going to help spur this activity. But to pause things for a month or 2 or 3 because of stock prices is normal. None of us like it, but I think it is normal, and I think we'll continue to carry on. I think generally speaking, this is a multi-year consolidation that will continue. Whether we see something big on the consolidation from the regional front remains to be seen. I'm still thinking it's next year's news, not this year.
Yeah, I think, when you're talking about large regional banks consolidating, they're typically stock deals. And so when you think about the volatility, forget looming recessions that just where we're in right now, we have volatile stocks. That makes it difficult for somebody like me to collar that and still get a deal inked, right? And so you want to see a little less volatility in the stock trading prices before you kind of firm up a deal. But when you migrate down to the community bank level, a lot of those transactions tend to be cash. And multiples are pretty thin right now, relatively speaking, to prior years. And so a overcapitalized bank you can really explore growth right now for relatively cheap compared to where it's probably going to be 1, 2, or 3 years from now. And so I don't expect those deals to change. It has to be the right fit. But I have seen in my practice a couple of deals put on pause just because of uncertainty. But that's largely just a recessionary fear. And are we paying too much? Even though the multiple's thin, it's still, are we paying too much?
Yeah. Well, it sounds like from looking at the quarter, bank margins continue to improve. Chris, maybe give us some color. Why are some banks seeing more margin improvement than others? What sort of characteristics are they? And what can banks do to capitalize on a more favorable net interest environment?
Sure. So I think that the answer to your question, John, has to do with how much they are wholesale funded. If you have a bigger use of broker CDs and borrowings, you're going to have a bigger delta in terms of, Q3 to Q4, which already happened, and then Q4 to Q1. That's the main driver, is that cost of funds is a bigger change because of wholesale. The other answer to your question is, if you are a larger fixed rate lender, and most community banks are 75-80% fixed rate, it's going to be a slower change on loan yields, which means as cost of funds goes down, you'll see margin widen. Those companies were particularly compressed after Silicon Valley failed. And it was less because of Silicon Valley, it was more because of the timing of the Fed tightening. And you really amped up the Fed tightening again after SVB failed. And that really squeezed margins the second quarter of 23 all the way into mid 24. So that unwind is happening now back for margins to improve. But a lot of it has to do with fixed rate financing. I think how securities turnover is going to help margin for some banks. I also think to a certain extent, the speed at which loan renewals occur will be a factor. If we see the 5-year Treasury below 4, that's going to drive more refinancing of mid and small business lenders or small business borrowers wanting to refinance loans. So that'll probably improve bank loan demand for the quarter, but it will probably squeeze margins a little bit. So I think margin's going to be a little bit of a back and forth thing. It certainly is not a one-way street. I do think the margins have room to come back, but I think it's going to be an evolution, not really a revolution, if you will.
So if you're a C&I lender, you're a credit card lender, you're going to have more loans that'll benefit from the rate environment versus, say, a mortgage or CRE lender?
Yeah, it's probably a broad generality. I think your CRE is gonna turn a little slower. C&I tends to reprice pretty quickly, and then the cards tend to be really more driven by where the prime rate goes. So if the Fed doesn't cut right away, you're probably still going to enjoy pretty good yields. What the banks are seeing is that the increase of losses on credit cards have been moderate and still are allowing them to have pretty good spreads. But I think as you go through a economic downturn, that will get tighter, and certainly unemployment is a huge factor to where some of those consumer performance and consumer margins are going to go.
Jason, Ed, thoughts on margins?
I mean, I agree with Christopher.
Same here.
We're in violent agreement. So it was announced, I believe, yesterday that the FDIC laid off, I believe, 1,250 people, or they're in the process of doing such. I know some other agencies, you mentioned CFPB. Are we concerned here that there'll be too many layoffs at these federal banking agencies and there won't be enough examiners or people to approve mergers? How do you all see that playing out?
But John, most of the attendees are banks, right? And I think they're laughing at that question. With all due respect, is listen, because when you look at your state regulator, if you're a state charter bank, when you look at your state regulator and what they're able to do with the staff that they have, and then you consider pre-layoff that the FDIC had nearly 2,000 more employees than the number of banks that existed in the country, I think it's fair to say that there were way too many people employed by the FDIC. I personally don't think that's going to impact timing of application review or anything. You just don't need 1.5, FDIC personnel per bank in the country.
My understanding of that FDIC announcement was that was a target to reach over time, whereas I think the CFPB already had the significant losses or significant cuts. My understanding is the CFPB, I think, has approximately 200 personnel left, and so that's been really the agency that's been had significant attrition. Clearly, cuts at the FDIC, but I think nowhere near the scale as the CFPB, where the focus is.
Yeah. I mean, it does seem like the new administration wants to see more small business lending, particularly out of the large banks. It'll be interesting to see how that plays out. We have an opportunity for some questions from the audience. If you have any questions, please fire them away in the chat function. It does seem like the FDIC, the Fed is probably doing more to assert its independence than maybe the OCC, FDIC is. Any thoughts on that with respect to how much this administration is able to change those agencies so far?
I would just say at the Fed, we need to look at its different missions, and there's monetary policy. I think that's where people and frankly the markets are really concerned about independence, and then there's regulatory and supervision, and I think there's some discussion about centralizing more of oversight for regulation and supervision in Treasury and under the Treasury Secretary, and having him set more policies. And I think people would probably have less reaction, if you will, to that side of it. So I think we need to kind of look at the different parts, and that monetary policy is where the concerns are.
Yeah. Bob,
I just have a question, John, is when you repeat this webinar 2 or 3 months, which you definitely need to do. This is a great panel. What is the tone of that webinar? In other words, are we still going to have this much chaos? Are we going to have more, or are we going to have less? Give me a very high level analysis of where this webinar is going to be in the future.
As far as predictions
I got you stumped, man.
go, you can have a view of the multifamily market in San Diego. You can have a view on manufacturing in Michigan. I think it's almost impossible to have a view of the entire global economy. As these trade skirmishes are picking up, you're seeing some unintended consequences.
Right.
I think we heard last week that China has all the rare raw earth materials, and some chatter that they're going to be withholding that. So I don't think we fully understand the implications. And quite frankly, this trade war could turn into a resolution fairly quickly. At the end of the day, if you take the top 10 trading partners with the U.S., and includes the EU, and you add Canada and Mexico, that's like 90% of all trade. So it's really it seems overwhelming. The administration's at war with 150 countries, but really there's only 10 to 12 actors that really matter. So it really depends on how quickly this gets resolved. We did get one question here. We know how many employees are left at the CFPB?
I believe it's roughly 200, give or take.
Wow.
200. Interesting. We want to wrap it up?
Well, Ed, I was going to say, a lot of this with the transfer to the states and all that, is really intended, I think, to ramp down the CFPB, right?
Yes.
Yeah. Bob, you want to ask anything or close it out?
Fine. Hey, gentlemen, that was awesome. I appreciate your insights, John. Good job for you in bringing together this all-star panel. What is your next webinar that you have scheduled? Do you have one yet?
We're working on. We got a few topics. Obviously, feel free to share it with you in hearing. We may do another C&I panel, another CRE panel, another workout panel. But we'll definitely bring this group back in 6 months, and we'll bring our other bank group back in 3 months after the earnings for the next quarter come in.
Thank you for joining us today for the webinar. This concludes this session.